5 reasons of why now is a great opportunity to be buying a home if your credit is beat up and you really don't have any money. 5. Hey, I'm Huddy. I got those 5 reasons for you. We're gonna get into it. First thing I want you to know, I've been doing this since 1999, so give me a chance, okay? My videos aren't that great, but the information is, so hang in there with me. All right, so the first thing that we want to talk about, competition. Why is competition so important? Well, if your credit's beat up and you don't have a lot of money, you're probably going to be using an FHA loan. Meaning, hey, if you got a 580 or you got a 600, your credit score is a little bit low, you only need 3.5% to buy it for a down payment to buy a house. So if you're buying a $300,000 house, 3.5% is $10,500. So it's still a chunk of money, don't get me wrong, but you can buy a $300,000 house with only 3.5% down with a credit score below 600, okay? So, well, competition, all right? I get it. And you get the people that, I'm waiting for rates to come down. Yeah, you and everybody else, right? Especially conventional buyers. So let's quickly break down competition, not just in the number of people, but the difference between a conventional and FHA loan. Both great loans. I'm a big fan of FHA. I do a ton of them. Does not mean a first-time home buyer loan. It is Federal Housing Administration. You can own 4 homes and then decide you want to use FHA to buy the next home you're going to live in. You can, okay? What's significant about an FHA loan is if you have a 580 credit score and 3.5% down, you can buy a house. So 580 credit score, and let's say you want to buy a $300,000 house, that's $10,500 down. It's still a chunk, don't get me wrong, but it's a lot more doable than $40,000 down, right? So FHA is an opportunity for a lot of people to be able to buy a home, but here's the competition factor. If I have 2 offers on my house, everything is the same, and one's FHA and one is conventional, I'm taking the conventional loan 10 out of 10 times. A couple of reasons why. Typically in the conventional world, more money down. So I feel safer about that. Means it's probably a better loan. I hear FHA, maybe they're on the rocks. Maybe something could fall apart at the end. They have bad credit. They don't have a lot of money. A little dicey. Oh, the most important thing, the FHA appraisal is tougher than a conventional appraisal. Because it's a government-backed loan, they're looking at things a little bit harder, okay? So a conventional offer is always going to be taken over an FHA loan. So that means if interest rates come down 1 point and 1 million more buyers enter the market, that's a lot more potential conventional offers competing against your FHA offer. Right now, when interest rates are up a little bit higher, there's not as many people competing for that same house. Not only that, sellers are going to be more flexible. So if you have an FHA offer and conventional comes in and they're like, hey, we'll get stuff on a discount. They offer 20 grand under, well, you're getting that house. It's a good thing, right? So competition in the sense that it's an FHA loan versus conventional favors you in a higher rate environment. So that's number 1. Number 2, I don't know if we want to call them flexible sellers, but if you're selling a home in a higher rate environment, it's for a reason. It's not because let's just see what we can get. Maybe someone died, could be that the people living there, they actually are buying a bigger house now. I'll get to that later. That's going to be bonus tip. Maybe they're buying a bigger house. All sorts of reasons why people have to sell. Maybe they're getting divorced. Lots of stuff. When people have to sell, they gotta sell. And if there's not a lot of buyers, there's more room to negotiate on everything. Home inspections, the price, getting your closing costs covered, a closing date could be more flexible. there's a lot of things that go into it in a higher rate environment. And if you're in that FHA world, just to give you an example, my son, he's 21 now, but when he bought his house, he was 20. And when he was going into this deal, he's like, Dad, rates are a little high, but I want my own house. This is what I grew up with me as a dad. Imagine that. Of course, my kids all buy houses. But his rate that he got when he bought was 7.25. Okay? Now, he went into this property, he offered $10,000 under asking price, got it, got his closing costs paid for, got a home warranty paid by the seller, and he was able to move in and close when he wanted to, because this person had to sell because they got a job transfer taking him to Louisiana. We're in Minnesota. That's a long commute. Guy had to sell because he was already in Louisiana working, so he had to get out for whatever he could. So my kid, he got in at a great time. Yeah, his interest rate's 7.25, but his payment's still $1,500. That's a doable payment for my kid. So it worked, and we're gonna refinance when rates get to where I want them to be for him, right? So that's a huge, just a quick story of the advantage my son had buying when rates were higher because no one else was offering on this house. Great house too. A little rural, out in the country a little bit. 3-car garage, 2-bath, 2-bedroom, $175,000, 7.25 rate, but he got his closing costs paid for, he got home warranty paid for, and he got 10 grand off. Let's talk about that equity growth. So this is my kid again. Like, he's my ideal example on this. So when he got that house appraised a year ago, it was actually last December 15th of 23. When that house appraised, it appraised 20 grand higher than what the purchase price was. Now that doesn't happen all the time, but it happened for him. But even if it didn't, and he's lived there for a year, if interest rates come down a point and a million more buyers enter the market, that causes home prices to go up. So when he's buying at a discount and now all these people come in and they want to buy, that by whatever Murphy's Law causes the value of his home to jump dramatically. So instead of maybe getting 3 or 4% appreciation, those rates come down a point, he's probably going to see double-digit appreciation in a very short amount of time, which will then allow him to refinance to get that lower rate and have more equity built into his property. Pretty cool, huh? Number 4, your credit might be a little beat up now, but do you know what it does to your credit when you have a mortgage reporting every single month? On-time payment, mortgage, to your credit. You're probably gonna jump 60 to 70 points in 6 to 8 months. The mortgage reporting is a little delayed, like sometimes it won't even hit your credit for like 3 months, but then it does, and all that pay history shows up, and a mortgage on your credit showing you're making payments on time does awesome things for your credit. So yeah, don't worry about it. The last one, number 5 here, I kind of brought it up before. Don't forget about the bonus thingy. But number 5, that refinancing later. So if your credit scores go up and rates come down, and you've realized this equity jump because you bought when rates were higher and now everyone wants a house, so you see appreciation dramatically increase, there's nothing stopping you from refinancing, getting that lower rate. Oh, and by the way, going from FHA to conventional, things could really be looking good in a short 2 to 3 years. It could be looking way better. If you're into that. Okay, so the quick bonus thing, this is what's really cool. So people are always waiting. They want perfect this, perfect that, blah, blah, blah. That first house you buy, rarely does anyone stay into that thing forever. I mean, I'm 48, gonna be 49 in a couple months, and I think take away rentals, houses I've live in, I think I've lived in 4 or 5. I've gone through the divorce and stuff and things, so maybe I have 1 or 2 more than everyone else, but 5 houses, I'm finally in my forever house. What does this mean for you? Okay, in 5 years, you can build a lot of equity. In 5 years is when you sell that house, maybe 7, but call it 5, is when you sell that house and you use that equity to buy the next bigger house in the nicer neighborhood or whatever. That's how that works. That's how Jimmy down the road, when he moved and bought a bigger house, well, how's he affording that? Because he took the equity. He took the $70,000 or $80,000 of equity and put it down on the next house, meaning his payment probably didn't really change that much. I know this because I do it for a living and I see it every single month. People doing this. That is how you get started. You buy a starter home, then in 5 years, you buy the next home, and in another 5 to 7 years, maybe that's the final home, or it's a different home. Who knows? Whatever home, buy a home. What's stopping you? Enough of that. Just to recap, I told you, competition, really honestly, that's the main thing. Get over the stupid rates. They are what they are. Competition right now is my number one. To be buying a house, especially if your credit's beat up and you don't have a lot of money. Remember, FHA goes down to a 580, 3.5% down. Do some math. Take a purchase price of like $300,000, times it by 3.5%. That's your down payment, okay? If you have any questions, drop a comment. I do lending in 49 states, so I can talk to you. Don't worry about it. If you subscribe or gave me a like, that'd be cool. I'd be shocked. Working on getting these videos better, but thanks again. We'll see you at the next video. You can watch something else if you want to. That'd be cool.